So, today we continue with bond markets. This is chapter 6, and now we continue with section 2, which is municipal bonds. The word municipal means of local government. Examples of local government will be state, city, or bigger county, or it could be even in the United States and some other countries, school district. In the United States, these are, let's use now red, tax exempt. Exempt, for example, maybe you from coming to the midterm. This means that if you're exempt, you don't have to come. If you're exempt, you satisfy the requirements, or you don't need to satisfy the requirements. So exempt, in this particular case, tax exempt means you don't have to pay taxes on, so investors, these are not taxable income. Tax exempt would mean that interest income is not taxable. Now, it's important to understand this is specific only to the United States. In some other countries, they may be tax exempt. In other countries, they may not be. This is particular to the United States financial system. So, for each country you operate in, you need to understand what income is taxable and what income is tax exempt. For every single country it will be different. Now, in my home country, this type of income is not taxable at all. But that's a different country. So, from tax exemption means that the interest rate is lower and could possibly be even lower than the Treasury's, because Treasury's income will be taxable, and for these they will not be taxable. In other words, when investors invest in securities, in any securities, investors always calculate the after-tax return. After-tax return. After-tax return is what is always calculated when comparing returns of two securities. You never calculate or compare the pre-tax return, always after-tax. Okay. Next one, the type of bonds. There are two types. One is known as general obligation. That's for those who follow the textbook, page 165. General obligation bonds are backed by the full faith and credit of the local government, whether it's state or whatever that might be. So the full faith and credit. It's a general obligation. It is not a specific obligation. There are no specific collateral. Nothing specific is backing these. And there is no specific revenue stream. There is no specific revenue stream. It all comes from the general revenue. Now we know that little paradise, which Americans call Hawaii, is a state of the United States. They issued billions, more like hundreds of billions of bonds, general obligation bonds. They cannot pay. So now the state of Hawaii is going bankrupt and hundreds of billions of bonds are in trouble, which means the investors that bought into them are in trouble. They're not backed by anything specific. It's a promise. And the one entity that you can't trust is the government. Because the government is nobody. Okay? If it's you, they come to you and say you gotta pay the money back. Okay? And in the best case scenario, if you can't pay, you get shot. That's the best case. The worst case is your family gets shot and they cut your hand off, right? That's how it works, right? But if it's the government, who is the government? The president, the state, you know, who is the government? You see, there is nobody particular to the government that is responsible for it. And therefore, the government at any point in time can just say, well, we're not going to pay. Or, well, sorry, we want to pay, but we can't because we don't have the money, because we're bankrupt. And that happens all the time. The other type, number 2, are called revenue bonds. Revenue bonds are bonds which are issued again by a local, we say municipal bonds, backed by a particular asset and its revenue stream. So the government will build a bridge and everybody who passes the bridge, they charge $1, okay? And that revenue of $1, $1 for thousands of people who cross the bridge will represent the backing of the bonds. Now, it may be that it's only the revenue which will back the bonds. So, whatever the revenue comes in, it will service the bonds. And the bridge itself will not be backing the bonds. Now, it may be that it's the revenue, and if the revenue is not enough, then the bondholders will own the bridge. That's possible. Now, it may be anything else. It could be, let's say, electric power stations. So, as customers pay for electricity, the revenue for electricity will service the bonds. Okay. It may be water treatment plant. So it will serve maybe millions of people. It will clean the water. You will sell the water to households or businesses or whoever buys water. And then the revenue from the water will be, again, servicing the bonds. And you hope that the revenue will be sufficient to cover the bonds. And if the revenue is not sufficient, then the bond goes into default. And now the question is, if the revenue is not sufficient, can you use, it's called the general fund, to cover the shortage or not? Let's get to that part. In the United States, the law says that you cannot use general funds to cover revenue bonds. The revenue bond must be covered only from its source of revenue. So if the source of revenue is insufficient, you're out of luck, meaning you lost money. Therefore, these revenue bonds are much higher risk. Now, this sounds a little bit of a contradiction. These are not backed by anything. These are backed by something, and despite the backing, they are higher risk. Here, they're backed by the full revenue, or we call it taxing power of the state. The state can tax anybody at any time. They can raise taxes, or they can cut other expenses in order to service the general obligations bond. Here, that's not the case. You cannot use the general funds of the states. So the revenue source is a lot narrower. And if it's not enough, too bad, you lost money. Okay? So these bonds are significantly higher risk, and therefore they will be having a higher return. Okay. You also have another type of a bonds. Let's see how I'm going to use this. Okay, I'll use the same trick from last time. It is, again, highly specific to the United States. It doesn't have to be applied to any other country. Other countries usually have something similar. Number 3, they call it industrial development bonds. An industrial development bond is issued by the government on behalf or for the benefit of a corporation. Maybe they're going to build, again, electricity, school, plant, stadium, whatever. Well, guess what's happening? If you have a corporation, the corporation could issue the bonds, and then the corporation is responsible for those bonds. But the corporation can do better. The corporation can get the government to issue the bonds, and then the government's kind of like responsible. And if the corporation doesn't pay, then the government has to pay. So this type of bond is a very good deal for the corporation. So, if it's a very good deal for the corporation, it is done for the benefit of the corporation by the government. What you can expect is corruption. A lot of corruption. If you're the corporation, you go to the government officials, say, hey, we can cut this deal and this and that, and I'll pay you a little bit of money, like $1 million, right? And if you're in the government, you take the money, you put it in your pocket or in your, it's going to be Swiss bank account, and then you issue the bond, and it's kind of like the corporation benefits at the expense of the whole tax, of the whole state, of the taxpayer, okay? It's like a subsidy by the taxpayers to the corporation. So, corporations love it. So, the first thing you got is too much corruption. And with corruption, we call it come abuses. Now, everybody gets the government to issue these. So, these get over time over-issued. The government assumes too many obligations that they can't all support, okay? And everything becomes a giant hope that things will work out. But again, the government, remember, doesn't care about that because the government, at least in the US and in most countries, they are elected officials. And they're officials only for 4 years, okay? So if you do it in your year 2 and year 3, if those bonds blow up after 5 years, you're not going to be in the government. You don't care. In the meantime, you got rich. And it's going to be someone else's problem down the road. So government, with its structure in general of election, is very suitable for corruption and abuse. And of course, later on, that's exactly what happens. So here, the important part to understand is not that these are industrial development bonds, but to understand that you have a structure where somehow the beneficiary will be the corporation. Some or most of the risk will be borne by the government, and if the government bears the risk, it is like a subsidy. You have a scheme for corruption, for abuses, and eventually for major bankruptcies and major losses. And that happens, again, quite often around the world, as long as you have these type of structures where business benefits at the expense of government. Let's see what else. Let's try to do this. Now we get, unfortunately, it's a little bit trickier, into the concept of investment banking. Investment banks specialize in the primary markets. So the definition of investment bank is that it is a financial institution which specializes, no, it's not there, it's on page 167. 167. Investment banking in the primary markets. For those who passed successfully the quiz, you remember the primary market is a financial market where securities are issued. So this means securities are issued and capital is raised, or fundraising, capital raised. So the main function of investment banks is to raise capital. So here investment banks do two main things. One is issue stocks. Now, the investment bank doesn't issue the stocks. The issuer is the corporation. The investment bank is the intermediary. It's the financial institution that helps the corporation to issue stocks. And the second biggest one is to issue bonds. Again, the investment bank is not the issuer. The investment bank helps somebody to issue bonds. They can help the government, they can help the municipality, the state, okay, or they can help the corporation. So we are concerned here with how investment banks, in this particular case, help issue bonds. And there are two methods to do it. Again, I'm at page 167. Firm commitment. And we call it firm commitment underwriting. Underwriting is the general process where the investment bank will assume the responsibility for the benefit of the corporation or of the government to issue the stocks. And now we get to firm commitment. Firm commitment means that the investment bank will guarantee the price at which the security will be sold. So the investment bank will say, if it's selling stocks, you say, we guarantee the price of $20 per share, no matter what. It may be sold at 25 on the market, may be sold at 17, it may be sold at 7, no matter what. With a firm commitment, they guarantee the price and they guarantee the quantity. So, if there is an issue, meaning when there is a brand new issue of security, the investment bank takes the risk. The investment bank assumes the risk. So when you issue securities, you try to sell them on the market, the investment bank will assume the responsibility and it will assume the risk for selling them. The investment bank will guarantee this is the price and this is the number of shares, and they'll guarantee price times shares, they'll guarantee the total revenue, and if they can sell it for more, they'll make a major profit. If they sell it for less, they'll have to take a loss. Well, that's the firm commitment. And the government, meaning the central government, before part number 1, the treasuries, will be almost always sold under firm commitment. Because the investment bank assumes, but not a very big risk. Now, if the municipality, the local government is solid, stable, and it will be easy for the investment bank to sell the securities, then the investment bank will use a firm commitment. They will guarantee to the government and to the local government, the state, the municipality. They will guarantee, they'll assume the risk, but they'll assume the risk when the risk is relatively small. Okay? And that's the one. And the other one, okay, well, let's do something else over here. The firm commitment underwriting could be, in turn, negotiated. Now, this negotiated is completely different from the negotiated securities. Here, the government will call the investment bank, and if you're the investment bank, I call and say, look, I want to issue $10 million of bonds, okay? And I'll ask you what kind of price you will give me. The price of a bond will be related to the interest rate. And you say, oh, I can give you 2.5% interest rate on your bonds. And we'll negotiate, okay, but your fee will be only, let's say, $50,000. And you say, no, my fee is $100,000. And we're going to negotiate the deal on all the details. That's negotiated. The alternative is called competitive sale. Or competitive bid. Now, these two refer to how the issuer will choose the investment bank. So, now I call you and say, oh, I'll give you 2.5%. Next thing, I'm calling you, right? And you're going to give me 2.4%, okay? And I'll call you back and say, sorry, she gave me 2.4, and your 2.5 is no good, okay? And then you say, oh, if that's the case, I'll do 2.35, better than her, okay? And then I call her and says, oh, I'll give you 2.30. So what I'll do is I'll basically, in a competitive sale or bid, I'll contact maybe 5 investment banks, maybe 10 investment banks, get a bid from each one of them about the terms and conditions. Maybe I'll choose the best deal. Maybe I'll tell the other guys, hey, this particular bank has given me this best deal. Can anyone do better? In other words, you try to get investment bankers to compete against each other for better interest rates and for lower fees. We call it for the better conditions. So, this is on the firm commitment. Okay, well, let's do a little bit more. Now, the investment bank, in turn, let's do some more investment banking, can form a syndicate. Syndicate is a group of investment banks and brokers. We call them a group of financial institutions participating in the issue of a security. So the investment bank says, oh, you guys want $1 billion. That's way too much for us, okay? So the investment bank is going to call 10 other investment banks and say, hey, I got a $1 billion deal. And you say, oh, I want 50 million. You call her, oh, I want 100 million. Oh, I want $70 million. So what the syndicate does is, if the deal is too big and the risk is too much, you spread the risk between 10 investment banks, or 20 investment banks, or 100 investment banks, or maybe only 3. So, syndication is the process of pooling resources of financial institutions to share the risk in an issue of a security. And number 2, that's the first one. Number 2 is called best efforts. Best efforts underwriting. And in best efforts underwriting, it's very simple. The investment bank does not guarantee the price, does not guarantee the quantity. The investment bank will sell as many as it could at whatever price the market will bear. Or the investment bank will negotiate something else. Let's say if it's a bond, they say, look, we will sell it, let's say, at 2.5% interest. But we can't promise whether we sell 5 million or 25 million or 50 million. We'll sell as many as we can. So the investment bank may agree that there will be a certain interest rate, and they'll sell as many as they can. They say, look, maybe if there are no buyers, we can't sell anything. And the issuer will sell, that's okay. Or the opposite, the issuer will say the opposite. Look, we need to raise 10 million, we need $10 million. Sell them at whatever interest rate. And the investment bank says, look, it may be 2.5, but it may be 2.7, it may be 2.9. We don't know how the market will respond. And the investment bank will send to mutual funds, hedge funds, whoever wants to be buying bonds, okay? And they'll determine that the market interest rate will be, let's say, 3.1. And they say, look, we sold your bonds at 3.1. And usually the issuer will say, okay, finalize the price and make the sale. So in best efforts, the bank does not guarantee the price or does not guarantee the quantity. They may guarantee the price, but not the quantity. They may guarantee the quantity, but not the price, okay? If they fix the price, whatever the market quantity will give. Or if they fix the quantity, whatever the market price will be. But they can't guarantee both at the same time. And they do as best as they can without major guarantees. And they'll be working on a commission. The investment bank acts as a salesman. All they're doing is selling the securities for the, in this case, municipality. So all they're doing is they are selling them. And if they're selling them, they're going to be getting a commission. Maybe 1% of the total revenue will go into, or 2% of the total revenue will go into the pocket of the investment bank. Of course, if you give the investment bank a higher percentage, let's say 2% or 3%, the investment bank will put in a lot of effort to sell your stuff. But if you give them only on 1%, they won't be putting a lot of effort. In other words, the effort of the investment bank will depend or will be determined by the commission. The third way that the bond can be issued is without an investment bank. Or it may be possibly with an investment bank. It's called private placement. Private is opposed to public. Public means to anybody. Anybody can buy, and it is for the general public. In a private sale and a private placement, meaning placement of the issue, placement of the securities, only private buyers are allowed. The difference is registration. If it's public, you must register and you must satisfy a large number of requirements which the law says what that public securities must satisfy the following list of requirements. If it's private, you don't have to satisfy all of these requirements. So what does private mean? It means that you're going to sell to other institutional investors. These other institutional investors will be mutual funds, pension funds, hedge funds, other banks, anyone who is a large institutional investor who can evaluate professionally the risk of the bond. Here, in a public sale, the public is protected with a large number of requirements. But public sales makes securities more expensive. The process is very expensive. And therefore, the return for the public is lower. In a private sale, it could be done quicker and cheaper and better for the investors, okay? And the issuer too, at a lower cost. So private placements have the advantage of being quicker and cheaper, but you're limited only to institutional investors. So the two categories are institutional and the second category is large investors. And large investors, you can think of millionaires. there is a strict definition which says a large investor is an investor who has a wealth or assets, investable assets of more than, let's say, $1 million, or annual income of more than $250,000. So these large investors, they're supposed to be smart, they're supposed to be sophisticated. Okay, let's get the other toy here too. Okay. And they're supposed to be large, they're supposed to be sophisticated, they're supposed to be, able to take losses. All right, let's see what else we got. So all I discussed so far was all of this investment banking section is about the primary market, the market for issuing the securities. Now, once the securities, meaning the municipal bonds, are issued, you got what is called now the secondary market. Secondary market. The main participants, or let's call them the main intermediaries in the secondary market, will be investment banks and possibly brokers. They'll be the main. The main characteristic for municipal bonds is that the market is thin. A thin market is a market that has few buyers and few sellers, and small changes in demand and supply result in large changes in price. So, thin markets, one way to describe it is that the market is illiquid. The market is not very liquid. Because you got a school district, which is different from a state, which is different from a city. Each city has its own details. So you have tens of thousands of different bonds and bond issuers. And each issuer may have 5, 10, 20, or 50 bonds. It's getting too complicated. They're not uniform. With the U.S. Treasury, you have only few treasuries, so they're fairly standardized. Here, they are too diverse, too difficult to analyze, and you don't have many active participants. So in a thin market, you have only few participants. All right, let's see what else. Oh, okay, well, let's do this. So, if the market is illiquid, the next thing means that the market is volatile. From financial management, you should have studied that volatility is the change of price. How much the price varies, okay? And volatility is measured by the standard deviation. So it is the standard deviation, but the standard deviation is not a very good measure alone, okay? Because the standard deviation may be $2, but $2 on a $20 stock is one, on a $100 stock is very different. So you need to take the standard deviation and you need to divide it by the mean to normalize it. Okay. So you need to have something like a coefficient of variation. So you'll actually say, oh, the standard deviation is $2 on $20 price, means 10%. But $2 on $100 price will mean 2%. So you want to measure volatility in percentages, not in dollars. So you need to take the standard deviation and normalize it by the mean. So that's part of the volatility. So these are relatively more volatile. So now you got two things going on. First, these municipal bonds have a higher default risk. So this means they got a higher default risk. This is the risk that they will not pay. But they also have a higher price risk. The price goes up and the price goes down, okay? So, the price, or we can also call it volatility risk. Volatility risk. So, there is risk of default, there is risk of higher volatility, and part of the volatility, but not necessarily completely different, is liquidity risk. Liquidity risk is that when you want to sell, you're not going to be able to actually find a buyer. Okay, that's liquidity risk. Let's see what else do I have, because I don't have very many things. All right, well that's it, camera. All right.